All right, traders, let's quickly take a look at the week ahead, where equities, especially the likes of the Nasdaq and the S&P, will be in key focus for this week, especially with US inflation on the docket. Now, last week saw yet another capitulation to the downside in equity prices, mainly dragged lower by two main drivers right now. On the one side, we've got continued concerns about US growth. On the other side, of course, is the ongoing question mark about tariffs. What type of tariffs we'll get, when will it be implemented? It seems like the story on tariff changes every other day. So the main focus right now is on the US economy, where growth has continued to show signs of slowing down. A quick example of this was the ISM manufacturing PMI that was released last week, where we saw a very typical stagflation print with growth measures all surprising to the downside, while prices paid, which is the inflation component, saw a big pop to the upside. Another quick example is the GDP nowcast from the Atlanta Fed, which is basically a real-time tracker for GDP within the quarter. We can see that that inched up from negative 0.4 up to 0.4, and that is after accounting for the big non-monetary gold imports that we had for the month as well, or for the quarter as well. So at 0.4%, that shows you that there's real concerns about growth right now, especially coming from the very lofty 3% that we saw going into the end of last year. Turning to the labor market, look, in a nutshell, the US jobs report was definitely softer or worse than what the markets had anticipated. But with these numbers, it's not really screaming a lot of stress right now. At 151, it was still a solid number for NFP. 4.1% on the unemployment rate wasn't really a scary number. And we actually saw a little bit of a move lower in average hourly earnings for the year-over-year component. So overall, even though growth is definitely still showing signs of stress, it's not a massive meltdown in terms of the labor market, at least for now. Furthermore, when we take a look at the services ISM PMI that was also released last week, remember services makes up about 80% of the US economy. So this one should be carrying a little bit more weight for the markets. And here we can see that we had a pretty solid print across the board. All 3 or 4 growth measures came in above 50, showing us expansion. But at the same time, we had that prices paid component, again the inflation component, surprising higher as well, which put the markets under a little bit of strain. And that all brings us to this week's main event, which is of course the US CPI data. Now, looking at this chart, you can see why markets are a little bit angsty and stressful right now when it comes to inflation risks. You know, the orange line shows us headline inflation in the US. The blue line shows us the commodity index for the Bloomberg Commodity Index. And the white line shows us the prices paid, the ISM prices paid composite between manufacturing and services. You can see both of these two leading indicators are showing us potential upside risk for inflation in the months ahead. That is why the markets have been, fearful of this current stagflation environment, and that has been one of the key drivers for this equity stress that we've seen in the short term. So what does this mean for inflation then in the week ahead? We can see market expectations for the core measure year over year is sitting at 3.2%. That is down from the prior of 3.3, with the headline expected at 2.9, again down from the prior of 3. Now we can see the market's minimum and maximum expectations for core is sitting at 3.1 and 3.3, while the headline is sitting at 2.8 and 3%. So what does that mean? It tells us that if we were to see inflation on the core and the headline side surprising above, let's say 3.4% for the core, or above 3.1% for the headline, that could put some additional stress to the downside in equities. And if we were to see a massive deceleration in inflation, surprising maybe below that 2.8 mark for the headline, or below 3% for the core, that could start to see a little bit of mean reversion kicking in for the equity market. I mean, even with all of the growth concerns going on, just looking at that size of the move to the downside, which was about just shy of 12% from all-time highs down to Friday's lows, this shows us that there is already quite a lot of negativity priced into the equity space, which means that at these levels, it's not really that attractive to look for downside opportunities without a clear catalyst, for example, higher than expected inflation data. If we were to see higher than expected inflation data, key levels of support to watch to the downside would be that next key level of support at the 19,900 level, which coincides with the lows going back to last year, November. And below that, we've got 19,600 sitting nice and snug at that lows going back to October last year. And it also marries up nicely with the 1-week implied volatility support barrier sitting just below that level. If, however, we were to see inflation decelerate, giving equities a bit of a reason to rally, Key first level of resistance to watch will be that very important 200-day moving average coming in at about that 20,300 level. If the bulls are able to break and close above that level, next levels to aim for would be 20,500, which is the low from the 10th of Jan, and above that could be a move back up towards that 20,700. So there's a lot to play for in the week ahead. Watch out for possible mean reversion moves, and as always, keep the ongoing tariff saga on the radar as a possible risk as well.